I'm sure that you've been told that you cannot time the market. Well, guess what? I'm going to prove to you how false that really is. And in this video, I'm going to show you exactly how you can time the market so that you know when the top of the market occurs as well as when the bottom of the market occurs. And of course, we're talking about the real estate market. So let's get started. I want to talk about market cycle fundamentals, definitions, and solutions. So you've probably been taught over the years that someone shows you a market cycle chart and plots where your market is on that cycle, and you take that at face value. You've never actually been taught what the definitions are. You know what phase 1, phase 2, phase 3, and phase 4 is in recovery, in expansion, in oversupply, in recession. What you don't know is what are the fundamental principles that actually put your market in that position. And make no mistake that every market is different. Now, a lot of people, they're given the market cycle chart by Dr. Muller, and we're going to see a couple examples of those. And that market cycle chart is only available for the top 53 markets in this country. So if you live outside the top 53 markets, or you invest or you broker outside the top 53 markets, it really doesn't help you very much other than know that, okay, these markets are doing well or not doing so well. I live, within a few hundred miles or, 500 miles of such and such market. It's got to be close, right? Yeah, no, not even remotely close. So I'm going to show you exactly how to pull certain data from certain tools to show you exactly where to plot your market, as well as what each of these parts of the cycle mean, whether you're in recovery, expansion, oversupply, and recession. They do have definitions, and there are solutions that you can do in each of these parts of the cycle. So let's get into it. So Dr. Muller puts out a quarterly update. In his quarterly update, he explains he is considered to be the expert in market cycles, kind of how a market cycle is determined, or how he determines a market cycle and where your market would plot on that cycle chart. We have 4 phases of a cycle in real estate. Same thing with business. There are 4 phases in business. The real estate cycle will always lag the business cycle. So in phase 1, which is where it starts down here at the bottom, let's call this 2009, 2010. We were coming out of the Great Recession and we started to recover. So in phase 1, it's recovery. You're still negative rent growth, and it doesn't matter what your asset type is, whether you're doing multifamily, industrial, retail, office, self-storage, hospitality. It's all the same. Your negative rent growth, but your occupancy is increasing now, so we're leaning up towards that long-term occupancy average. And even though we have negative rent growth, as we call it in the multifamily space, as we put heads in beds and we increase the amount of occupancy, our NOI, I call that this vertical line. He doesn't really define the vertical line, but I call it the NOI line. So as your occupancy is increasing, your NOI is increasing until we get up to that long-term occupancy average. Now, we may still have some below inflation rent growth occurring, but we are starting to see rent growth. And as we exceed beyond the long-term occupancy average, we start to accelerate. So rents are starting to rise rapidly towards new construction levels, which is where we are here in point 8. So now our occupancy and our rents are high enough. So NOI is now at a cost feasible mark where we can build new construction. Again, doesn't matter what the asset type is. We continue to accelerate in rents and occupancy until we hit the equilibrium point, because around point 10, we're starting to deliver square footage or units to the marketplace. And now, can absorption keep up? As absorption no longer keeps up, we end up at a point of equilibrium where demand and supply are equal. So rents are neither climbing nor falling. Occupancy is neither climbing nor falling. Okay, and absorption is right at that level of equilibrium. As we move beyond the point of equilibrium and we start to head down the other side, We're still delivering units to the marketplace. As a matter of fact, properties are still going and starts. You still have starts during 11 and 12, maybe even to 13, because developers aren't paying attention yet. And so they'll still continue to start developing. We still have units being delivered to the marketplace, but now supply is exceeding demand. Rent is starting to decline. Occupancy is starting to decline as we work back towards our long-term occupancy average, even though we may have positive rent growth during this declining phase. Once we get below the long-term occupancy average, now we've got negative rent growth. We enter the recession phase. It happens fairly quickly until we end up at the bottom and back at point 1, where we come back up into recovery again. From point 1 to point 11 could take a long period of time. We saw during the Great Recession, we started, remember this was around 2009, 2010, and went all the way up probably to about 2022. So 10, 11 years, that's a long time to be in expansion. Longest we've ever had. Then as we have entered into oversupply, now some markets are still in oversupply, some markets are in recession, depending on the product type. Office is all over the board. Industrial's pretty much right at equilibrium and a little down into hypersupply. Multifamily's got some at equilibrium. Most are in hypersupply. There's some in recession. There's a couple of markets, according to Dr. Muller, that are in recovery already. I'll show that to you in a second. So depending on what property type you are is where you'll be in the market cycle. And I don't go over each property type in this lesson. But as we get into oversupply, this period here could take anywhere from a year to 3 to 5 years, depending on how long you sit in that oversupply phase and how much is really under construction, how long you've been in that expansion phase. But the recession typically is the fastest part. Once you get below this long-term occupancy average, the rents are going to start to come down fairly quickly to be able to start to get into that recovery again, which is why we don't stay here very long. No matter what the economy is doing, we could be in a major economic recession. Banks could be falling through the roof, but owners and managers will adjust to get the rents correct so that you will start to grow again. And that's why we stay in recession for such a short period of time. So where we can identify this point 16 and where we can identify point 11, that makes us winners, because we can buy at point 16 and we can sell at point 11 or even at point 10. And you're never going to fail if you can do that. But how do we identify, without looking at Dr. Muller's charts, which are about 2 quarters back, how can we identify more current information? And if we're not in the top 53 markets, how can we identify it for our market so we can have a competitive advantage? And that is what this video is about. How to give you that competitive advantage, or if you're a broker, how to give your clients that competitive advantage and just make you that much more valuable to the marketplace. So here's Dr. Muller's first quarter 2024, which is the latest. We're almost through the third quarter, and he still has only put out the first quarter of 2024. That's his latest one. For multifamily, we can see that we have a third of the markets that are in equilibrium. We've got one property in expansion, or one market in expansion, which he's moved backwards. It was sitting here at point 13. He's moved it all the way back to point 10, which tells me there was a major employment announcement in Norfolk. Then we've got 2/3 of the market sitting in oversupply. We've got a few markets sitting in recession, and we have 2 markets, and Jacksonville could be considered, whether point 1 or on either side, whether it's still in hypersupply, or still in recession or starting recovery. Once you're in point 1, it's just, are you on the front side of point 1 or are you on the back side of point 1? And then he's got Memphis at point 2. So again, only the top 53 markets in the country, and that's by population. That's what the top 53 means. So the top 53 markets by population is what he shows. So let's see how we can identify how to plot our own market. So this is Orlando. I took this about a year ago. There were 213,157 units in the marketplaces for multifamily, total of 1,492 properties. There were almost 24,000 units under construction, and in the last 12 months, 3,533 had absorbed, but the prior 12-month period, over 15,000 have absorbed. So absorption has slowed considerably in Orlando. Vacancy rate is 7.7%, which is an increase. So occupancy is decreasing in Orlando. Over the last 12 months, it was 5.2 the 12-month previous to that. And market rent per unit is continuing to rise, so we still have rent growth year over year, even though our occupancy is decreasing, okay? But we're going to look at it on a quarterly basis. If we look down at our long-term occupancy average, we can see that over 23 years, Orlando likes to be at about 92.5%, and it's about 92 1/3 now. So we can argue that just looking at this information, Orlando is sitting on that long-term occupancy average. More than likely, since we're building units, they're delivering and we're absorbing, and vacancy is starting to increase, we could say that it's probably in the hypersupply phase, getting close to that long-term occupancy average. But we can go into data and we can dig just a little bit deeper. So we can see here that our effective rent, and I like to look at effective, not asking rent. Asking is just that. They're asking this rent, doesn't mean they're going to get it. So I like to look at effective rent because we can see that it's about a $14 difference per month per unit from asking to effective, which means there's some concessions that are happening. So if we look at effective rent per unit in 2022 going to 2023, again, this is about a year old, we can see that it started at $1,743, went up to $1,815, and then started to decrease. This is on a quarterly basis. So Q1 2022, Q2 2022, Q3 2022, Q4 2022. So it decreased all the way down. If we look at our growth, we can see that our rent growth was declining as well. If we continue over, we can also see that our occupancy was decreasing as those rents were decreasing. So that shows fundamental principle that as occupancy decreased, rents decreased. You can see over here that we delivered 1,500 units in the first quarter, 950 in the second, 3,400 in the third, 2,700 in the fourth. We're going to ignore first quarter of 2023. So if we look at what's still under construction, you got 24,000 units still under construction. And if we look at deliveries to absorption, meaning what was the total number of units during this period that absorbed? So 1,516 delivered and 1,745 absorbed. So not only did it absorb all of the units that were delivered, it also absorbed some of the vacancy in the market, which is why occupancy increased from fourth quarter to second quarter. But then things start to go a little bit awry. So now we deliver 950, but we only absorb 869. That's still not bad. I like to say if it's within about 80%, if absorption's within 80% of deliveries, it's a fairly stable market. But then we deliver 3,400 in the third quarter and we only absorb 223. And so occupancy starts to tank at this point. Then we deliver another 2,700 and only absorb 517, and occupancy continues to fall. Okay, so we can see that rents are declining because of that. So we have declining occupancy, we have declining rents. Even though we still have rent growth year over year, the rents are declining quarter over quarter. Absorption has slowed to an almost stop, although we do see it pick back up again in the first quarter of 2023, but we're ignoring that right now. So where would we place this on the market cycle chart? Well, it becomes fairly easy now to say that, remember, we were sitting on that long-term occupancy line, but we still have year-over-year rent growth. Absorption is slowing, rent growth is slowing. It's actually going negative quarter over quarter, but there is still positive year over year. So I would plot Orlando either here or here, somewhere in between these two. You could probably put it here, still be okay in the middle. Doesn't have to be exactly on these dots. Just know it's on in oversupply, heading towards this equilibrium line. Even if you were to plot it on equilibrium, you probably wouldn't be wrong. You can be prepared to back it up into oversupply again if you needed to. You can back it up or move it forward. What you cannot do is you cannot skip a phase. It has to go through each one of these phases. It cannot skip a phase, but it can go back and forth. Okay, and we saw that in Dr. Muller's. So that's how we can plot it. So by looking at that data, and you can use any supply side tool. I used CoStar, but you could use Yardi Matrix, you can use Moody's, or any of the other supply side tools out there. Do not use Crexi, do not use LoopNet. Those are not data analytic tools. Those are listing exchanges. You have to pay for those tools. You can't get around that, or build a relationship with somebody that has those tools. Or if you're in brokerage, go to a brokerage company that provides these tools. All right, you're going to need these tools to be able to do this. But once you've been able to plot it, now we know. We may not be able to predict when we're going to get to equilibrium, but we know when we've hit it, or we know when we've just started to go past it. We can see it coming, can't predict exactly when we're going to get here, but we definitely can predict as we start to pass it. And within about 6 weeks, 6 to 8 weeks is about the age of the data when you get it from that supply side source. That's a lot better than 2 quarters back that Dr. Muller provides. And you can do it in a small market. I'm in Mobile, Alabama. Mobile, Alabama is not on Dr. Muller's charts. The closest market to Mobile on that chart is Atlanta. Well, guess what? Atlanta is nowhere near what Mobile is. Even Birmingham, which is the largest market in Alabama, is not on that market cycle chart. So if we want to be able to identify our market, we have to learn this. So now we can start to time that bottom. We can see when we're in negative rent growth, we can see we're below that long-term occupancy average. And what happens is you're going to start to see it slow. So the next set of data points you get the following month, you're going to start to see that the occupancy is starting to slow its downward trend. You're going to start to see the rent decline start to wane a little bit. It's still going to be a declining rent, but it's going to start to slow. And as you start to see those indications, give it one more month. And if you haven't surpassed it yet, you're probably, because 1 month is not a trend, you start to see 2 months of that trend, you can probably rest assured that you're going to be right about this mark right here. And to me, that's buy signal all the way. Your clients would love to be able to identify that they're 1 point from the bottom, getting ready to head back up the other side. All right. So let's look at some definitions and some solutions. So in the recovery phase, in phase 1, we call that the transition phase. This is a period of reinvention. You have a new business model. You're diversifying risk. You have a renewed customer focus because you're coming out of the recession phase where you may have had to do some repositioning. Cash is still king because there's probably a lot of foreclosures on the market. Banks probably aren't lending yet, so cash is still king at this point. We're focused on fundamentals. We're not focused on pro forma, and we're starting to consolidation is accelerating. You'll see in the recession phase that consolidation starts to pick up, but we're accelerating now through the transition phase. Our solutions, build pipeline, okay? We want to accelerate those value-add acquisitions because there's going to be a lot of foreclosures that are going to be on the marketplace. We're rebranding, repositioning coming out of that recession phase. We're not building yet, but we're starting to initiate development. We know as we go up that recovery side that demand is going to start to exceed supply. So if you're in the development business, you're starting to get that mindset We're doing some site selection. If we've got sites that are ready to go, we're starting to get all of our entitlements in place and start talking about utilities, things like that. Start initiating that development. You're just not developing yet. Now we're expanding offerings, and again, we're repositioning our assets because of what happened in recession. Then we get into our expansion cycle, which is known as the growth phase. Our opportunities here, we have rising occupancy levels, rising rents and growth in NOI, increase in asset value. Development activity now starts to take place. So now we're actually beginning construction when we hit that 0.8 and NOI is high enough to make feasible sense to get a profit. There is available capital and new competitors start to enter the marketplace. Where competitors should have been entering down at the bottom of phase one, they wait until we get into the expansion cycle when even a monkey can sell real estate. And so the new competitors start to hit the market in the growth phase. Our solutions here are expand vertically, expand geographically, expand your customer base, invest in infrastructure, expand adjacencies, which means two things. You're expanding on the properties that are around you. Also, expanding adjacencies means if I'm doing multifamily, maybe I expand to an adjacent asset type like student or even senior, and then leverage that capital platform. As we enter oversupply, that is the plateau phase. Here we're in periods of decision, so demand-supply imbalance, meaning our supply is exceeding demand. There's still optimistic underwriting occurring, unrealistic asset values because people have not captured the fact that we have gone beyond the point of equilibrium. There's generous TIs in commercial or generous renovations going on in apartments or value add opportunities. Rent concessions are occurring, but there's still high investment activity in oversupply or hypersupply, which is the plateau phase. Our solutions here: dispose of non-core assets, lock in long-term debt, not short-term debt, long-term debt. Accumulate cash because as you get into recession, banks will not be lending. Downsize your non-core markets. So if your market is Dallas and you've been investing in Birmingham and Oklahoma City and Nashville, Tennessee, you'll start to sell those assets and bring it all back to Dallas until you start to go back the other side again. And build third-party work. And this is especially important if you're a broker. Transactions are going to get fewer and fewer to almost coming to a halt. So you're going to want to build third-party work like consulting so that you can make it through the recession cycle and come out the backside and not have to go get a W-2 job somewhere. Crisis phase, this is a period of change. We're now in recession, declining rents. Little development is occurring. As a matter of fact, the ones that still have not delivered are probably going to go bankrupt during this phase. There's limited access to credit. You're deleveraging as much as possible. Declining asset values. Lenders are doing workouts and restructuring where it makes sense. And entities are downsizing. So remember, we were downsizing our core assets in the prior phase and the plateau phase. And we were downsizing our non-core markets. Now we're starting to downsize our entity. We're laying people off. We're shrinking because it's just not making feasible sense to be as big as we were. Our real estate solution here, no surprise, especially as you get down to plot number 16, acquire underperforming assets, acquire necessity real estate, and acquire market share, customer base, and talent. So in other words, buy. But you have to know when you're getting at about 0.16 before you start that process. Keeping in mind that that recession phase is a very short period of time, typically anywhere from about 9 to 24 months, and 24 months would be on the long end. So if you found this video valuable, and I hope you did, I hope this worked out for you, please make sure you share it. If you have not, please subscribe to my YouTube channel, as this is on YouTube, and I hope to see you in the next video. Thank you for watching this presentation.